strategy I'm about to share with you is known for passing prop firm challenges, getting payouts, but also making traders consistently profitable over a long period of time. It's the well-known opening range breakout strategy from Toby Crable. From this book, I've tested so many different variations of this original opening range breakout strategy that I want to share everything step by step for you, that you understand how the strategy works, how you can use it yourself, and how profitable it is. So let's dive into TradingView and show you the original ORB strategy and then move from there. We are here on Bitcoin, on the Bitcoin chart, but this works on FX, but also stocks, whatever you're trading. This strategy is multifunctional. I think it's very powerful, especially when you know multiple variations that haven't been shared before. So that's why I'm making this video. The original opening range breakout strategy works like this. You have a ranging market, and what you do is the last candle, you look at the open price, you add a little bit of like a few pips or a few points depending what you trade. You add a little value to it, and then you have a breakout level. And the original version also works the other way around, where you take the opening price minus the stretch value, and then you have your sell breakout level. This is the original system, the original trading strategy that has been used many times over the past years and decades, even when this strategy was invented. So how price works is you have volatile times, a volatile market, and then it consolidates, it slows down a little bit. And if you really think about it, it's like the market is getting narrower, and then it wants to explode like a spring. It wants to explode in one direction, like starting a bullish trend or a bearish trend, a trend to the upside or the downside. And this particular strategy is built to wait for that market to shape up and then add above the opening price a level. If that breaks, the rest of the day or the rest of the session, price will move in that direction, and then you have your risk to reward and your big trades. Same for the other way around, right? A level, price crashes through it, you go short, and then you bank those big trades because you expect from consolidation to go to a volatile market with big breakouts. That's the original philosophy of this system. But what is this stretch value? Because that's not shared often, but it is in the original strategy. So if we follow this arrow, you can see how to find the stretch. First of all, you have this candlestick. So you can run this on the 1 hour, on the daily time frame, on the 4 hour time frame, the 8 hour. Doesn't really matter. The formula remains the same, and it's super simple but super powerful. What you're checking here is this wick here, the upper wick, larger than the lower wick? If that is true, the formula is as follows. Take the close price minus the low. In this particular candle, you have here the open, here the close. So you take this close price, and then you take this low of the lower wick, and that is your value. We will do some more examples during this video, so make sure you take notes and sit down and do this with me. Or if the higher wick is not the larger, then the largest wick is the low wick. And then if that's the case, take the high minus the close. So you take this and minus the close. That's here. If we then see, okay, step 2, take close price minus the low. How does that work, and what can you see here? Let me zoom in a little bit. You see that same candle, then the close. So the close price is 126,944 for this particular example. And then the low in this case is 125,583. If you take the close price minus the low, then you have this value. And the key here is, all right, that's just one value of the last candle. But what you're gonna do is go back and do the same trick for the candle before this and before that. You can decide if you do that 3 times or 4 times or 5 times or maybe even 20 times. Then you start seeing this value and then the second value, and you take the average of all of those. How do you do that? Let's say you do this 3 times. You have this value, you have another value and another value. You add these 3 together, divided by 3 because you did it 3 times. If you have 20 values, add all the 20 values together, divided by 20, you have the average. And that average is key. You need that average. And if you have that average, you go back, and that is the stretch value. That is the original orb strategy. You have a little bit of variations. Most of the variations are if you buy here and sell here, then do you only trade one time or two times or three times? How many trades do you get? Where is your target? Where is your stop loss? And you have a lot of variations, but this is the original orb. Then if we check the variations, I've listed a few for you. The first one, only take buys or sells with the trend. So you're doing this analysis, but instead of going for the buy or just and the sell, you just take buys when you are with the trend. So above moving averages, or you define the trend with other easy filters, and then you only take buy breakout trades. Same story is true for sells. Maybe you're in a bearish market, you only want to take the sell opening range breakouts with the nice stretch value. Take the opening price plus the number we just calculated, then you have your buy level. If that breaks, you go long. If you have the open price minus that value we calculated, then you have the sell level. Then we also have only take buys or sells against the trend. Maybe the edge is there that if you are in a bullish trend and then you get a setup like this, then you want to go short because a lot of people are long, they're getting stopped out and there's a lot of momentum to the downside. How do you want to manage this trade? Is it at the end of the session? Do you want to use a trailing stop loss? Is it a fixed risk to reward? Those are questions you ask yourself with testing this strategy. I love to have a trailing stop loss because then I capitalize the most if I catch a new trend. Then point 4, use range filters, narrow range. This is not the original strategy. This is the second strategy he is known to trade. The basics are the same. It's still an opening range breakout with that stretch, but there is a narrow range extra condition to check. Let me move there. The narrow range strategies. You have one variation is the single day and you have the multi-day. Single day, how does it work? Let me show you. You have here a few candlesticks and the size, this range of this candlestick is bigger than this one, is bigger than this one, is bigger than this one, and this is the smallest. What price is doing is getting smaller and smaller and smaller, consolidating. Often people trade price action patterns and some patterns work really well, some don't work that well, but they do work because everyone is watching price and getting smaller and smaller. That's like a wedge pattern or a triangle pattern. That's what you can draw in here and I showed you. So if you're familiar with price action patterns, it all comes down to why is that price action happening, and what is happening is that price is getting smaller and smaller, and then we want to trade the breakout of that because remember that spring, it wants to explode, right? Price wants to explode after consolidation. The single day strategy, smallest range in X days. You compare the last candle with the candle before that, then this one with that one, this one with that one, and then the conclusion is this candle is the smallest compared to all of them individually, and then it's a valid setup. Then again, you take the open price, add that stretch value or minus the stretch value for sells, and then you take the breakout. This is the single day strategy. Now let's go to the multi-day strategy. Smallest range versus ranges before. This strategy, super powerful. What you do, instead of watching one candlestick, you group them together. I like to call it like teams. You make teams and you group them together. You take the last two candles, the lowest low of the last two, the highest high of the last two, and then you have a range. Then this range you compare with the other two before that, the other two before that, other two before that, and you keep doing that. You can also make variations where you compare the last three candles with the three candles before that, before that, before that. You know where I'm going? You have a lot of variations of the orb strategy, and these are extra filters that are used by the original owner of the strategy. It's a powerful strategy. If you go back to the basics, what do we now have? We have the simple original strategy with the open price, the stretch value, and where to buy, the open price minus the stretch value, and where to sell. Before that, what is happening in the markets? You can add those other variations. Are we in a ranging market? Are we in a trending market? Is the market exploding, or is it price getting stuck? Is it getting smaller? Those are all questions you can ask yourself, and then you can automate this strategy. I like to test all these variations not manually. I automate all of these strategies with no coding. No coding means you are taking your technical analysis like this, your trading plan, put it in to an algorithm, but you don't have to code because that takes too much time to program it instead of programming and learning that first of all. But if you are a developer, it just takes you an hour to build this. We can do it in a few minutes if you no code it. And that's why I love no coding. There's one strategy that is called NR7, narrow range 7, which means that in 7 days the smallest range is the smallest range compared to the 7 candles before. 6 candles before, and then the candle 7 is the smallest. So you have 7 candles, right? That is one of the variations I explained to you. And this is an example here. You have price big moves, big daily candles, and then this is the smallest candle. So I'm gonna outline the high and the low of that candle. And then what you can normally do, or what the normal variation of this strategy is, if you then go to the 1 hour and you go here, what you have here is 3 lines. I took the open price, the high, and the low. If you have a stretch, you have 2 variations. You can now trade this breakout of just the high of that candle, or you have that open price plus stretch. Let's say the stretch, I'm not gonna calculate it for you right now, but let's say the stretch was 1.5. So 1.5% above the open price I want to buy. Then it looks like this. Your price started to move to the upside, you have that confirmation, and then you go long, and then you have your stop loss. Let's say you use this low here. And this is then the variation of that opening range breakout strategy. And let me quickly close that. And then you have your 1 to 5 risk to reward, or your trailing stop loss, or maybe a bigger risk to reward or a smaller one. What do you want? My big tip is, if you start trading trends and breakouts and you want to catch the trends, your strike rate might be a little bit lower because you're trying to time that explosion in the markets and that new trend. Therefore, you need a high risk to reward. I recommend going with a risk to reward of 1 to 5 around that area. That's the best in my opinion. Most strategies perform really good with a 1 to 3 risk to reward, or 1 to 5, or somewhere in between. Going to like a 1 to 10, your strike rate will be very low, and it's not really that nice based on the thousands of strategies I've been building, automating, and testing over many years of data. I found that 1 to 3 risk to reward, or 1 to 5, or trailing stop loss is just the best thing to do. If you want to learn more about no coding or watch other videos on this channel, make sure you subscribe below, like this video, comment your questions, and I see you in the next one. Thank you for watching.